It's time now for the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors, a family-owned independent insurance and financial planning agency since 1947. Now, from their studio on Star Center Drive in Canfield, Ohio, here's the host of your program, Leo Daprile.
Welcome to the Gem Young Wealthcast. This is Leo Daprile. Well, today is part 2 of our analyst analysis for the quarter, and I have with me Stephen Daprile. He is the president of Gem Young Wealth Advisors. He runs the show these days. Hey, Stevie.
Hey, how's it going? Thanks for having me here.
You got it. Good. Glad to have you. So, to say the least, it's been an interesting quarter. The war continued on, came to a resolution, but the markets through the quarter didn't really seem to care. I mean, there was a post bump after the agreement, but we kind of marched on through the quarter.
Yeah, I mean, things really, as a matter of fact, kind of the opposite, right? I think things really bounced off the mat. I think at the end of the first quarter, the S&P 500 was down almost, 5%, and everything's really seemed to bounce off the mat since then, right? Earnings have kind of come in, sentiment softened a little bit. I think the war has become more old news rather than it has been, than people are thinking about it. That and the consequences surrounding the oil situation, rationally, right? Are all those concerns dissuaded? Do those persist, right? Those are questions that you can be asking, but earnings have certainly been strong. And at the end of the day, if you make money, people want to pay more for your stock and your stock's worth more, right? So that's really lifting the overall performance upward.
I think what was an interesting trigger that in the 2 days post-agreement, just those 2 days, the price of oil dropped almost 10% in those 2 days, which is significant. So we'll see how quickly that starts. Is this going to be 3 months, 6 months till we really start getting back to low oil prices again? Because I think the challenge that everybody's been talking about is, okay, things are open and things are moving forward, right? But I forget, there was like 600-700 ships maybe in the Strait of Hormuz waiting to load up.
Yeah, well, I think part of it is there's like record low reserves for oil. And I think there's still going to be a lag on getting oil back to quote unquote normal pricing because companies are going to be replenishing their reserves, which are dangerously low, allegedly. Based on, again, an article I was reading the other day. So it sounds to me that there's going to be a little bit of a lagging effect with that. And then also you have to think about, whether or not some of this is going to be transient, right? Is this inflation here to stay, right? You can rationalize it and you can, say, hey, it's just a bump in inflation. Companies are just going to eat that price. Or are they going to charge more? And if they charge more, are they going to bring their prices back down when oil's lower, right? Is that really how things typically work? I think a lot of our evidence in 2021 and 2022 is evidence that no, it really doesn't work that way, right? Inflation tends to stick around. Stuff doesn't really claw back too often, particularly oil will, because it's a volatile commodity. But every product and service you use needs oil from one part of its supply chain or another to get to your doorstep, right? Or to get to the store where you pick it out. So, I think it's very interesting to see, and certainly it hasn't. I mean, I think we've seen hints of it in the second quarter, but it hasn't played out from a macroeconomic perspective and really pervased itself to the rest of our economy. So we can really look at it and say, okay, what has this war done with inflation? Which frankly was already kind of a question mark heading into the year. Should we cut rates? Is inflation going to hold out? This, that, or the other thing? And at the end of the day, the war has thrown a wrench into our expectations for what that looks like. So there's a lot to unpack there with what the Federal Reserve's doing and how that affects the market. So certainly an interesting thing that we've seen play out. I think we were all looking at the war in Iran and we were thinking that this should, ideally this should wrap up soon, right? It should be a quick war. And, by all standards, it still has been, but I don't think as quick as we expected or would have liked from an economic perspective, putting all the other humanitarian stuff aside.
I'll say the same thing, that when I go by a gas station, what I'm looking at every day is not the price of gas. I look at the price of diesel, and I wonder what diesel's doing to my grocery store bill, right? Because that's the biggest price increase. The only hope for prices coming down is competition amongst different stores, trying to get their market share back, trying to get their foot traffic up. Because with the inflation, what it's doing, people are curbing what they're buying. So store sales are going to suffer, even though they're getting, and I don't even know, Stephen, if stores are even getting a bigger margin of profit at this point. I think it's probably more just covering the increased cost of getting their product to the store, like you said, and then having to pass that on. But I don't think to increase your margins, and because of the cost of fuel, I think that's too much in today's world, because wage inflation has not kept up with this short-term spike in traditional inflation.
Yeah, I was going to bring that up.
Yeah.
Yeah, because it has. That's what's been interesting about, to your point, that's what's been really interesting about the inflation cycle that we've been on. Let's just, say since, 2020, to make it real broad, is if you look over that time horizon, wage inflation has certainly catched up. So even though the consumer's spending more here and there, they are on average and in aggregate making more to be able to afford it. And I think but that's unique, right? And this is a unique squeeze, right? Is this going to be an outsized squeeze that the average consumer can't handle? And I think we're yet to see how all that plays out. And of course, it's supposed to be, not supposed to be, but because of the nature of what's causing this inflation, it wasn't like, think COVID, where it was a disruption to the supply chain and things had to, time is money, and things had to stay longer in different places, and that would make the transition of those cost more, right? So this is kind of a different ballgame, where the inflation is stemming from one very, very important commodity, but one commodity effectively nonetheless.
Yeah, and I think my position is prices are going to come down because of the fact inflation far exceeded traditional inflation and it exceeded wage inflation. So it's going to be difficult for stores to hold those prices, in my opinion. So I think that's good news, but I don't think it's going to be as quick as people want it to be, because with the bottleneck of getting the distribution of oil back on track, and remember too, there was a lot of oil facilities blown up. So that's going to take longer to get online. It's just like, okay, the tanks are on full load, line the ships up, we'll load them up. I don't think it's going to be that simple. So I think that's going to put the Fed in a longer term challenge to watch inflation for a longer period of time, to monitor how quickly that can fall, in my opinion. So I think there's going to be that's not going to be as quick as everybody hopes it would be. Even though I bring up the point of what the price of barrels going down, I think we'll see longer term. And Glenn and I talked about this in the last quarterly call, that we actually have an oil glut around the world, but till it gets to where it needs to go, it's a shortage to certain countries.
Right.
Yeah,
exactly. I think that's an oil glut. I think that's a good point. I think, yeah, and we'll have to see how it all plays out. From a market's perspective, I think if you look at it like that, and I think you look at the inflation and you look at these numbers and you say, well, the market's largely been up in the face of all the inflation, so who cares? At the end of the day, earnings got to persist, and that's what's going to keep the economy rocking and rolling. Even if inflation is high, if earnings are backing it up and beating out inflation by a standard margin, we don't really have anything to worry about to begin with. And that's really where I think our eyes need to be going forward, is because of the nature of what we're presuming is a largely an outsized spike in inflation, right? How does that look going forward for earnings, right? So if we can hold on to earnings and inflation's up and it comes back down, I think we could weather the storm, right? But if earnings really start to have a legitimate pullback, that's just like any economy. I guess from that perspective, there's nothing unique about that. But I think it would put an enormous amount of pressure on the economy if earnings really do start to stumble across the board.
So last time we spoke, we talked about the rising stock market, more profitable companies, and consumer sentiment getting worse. Well, the latest report out continued to confirm that, right? The consumers they're more pessimistic than they've been, but they're still spending. So this dichotomy of behavior and feelings are continuing on, which I continue to find that interesting.
Yeah, I think there's a lot. I think there's a lot to unpack with sentiment, and I've hinted at this at previous shows, and at risk of repeating myself, is I have grown to, and I like to think a lot of people are on board with me who are not really putting much stock in the consumer sentiment numbers anymore because of the hyper politicization. Politicalization. Thank you. Nailed it. Of our country.
It's like saying, when I was a young kid, the tongue twister was rubber baby buggy bumper. And to say that 3 times.
Rubber baby buggy bunker.
See?
It's tough.
It's tough, isn't it?
That's a tough one.
Yeah, right. Okay, there's some useless knowledge for our listeners.
There you go. Yeah.
But if you're my age, you know what I'm talking about.
Right. But I've been putting less stock into those numbers because I can't do it.
The polarization of the politics. How's that?
That's so much easier. The polarization of the politics in our country has lended itself, and I think candidates for way too long have been hitching their wagon to how the economy performs as how good of a president I am. When in reality, I don't think the president has only so much control over what actually happens in the economy, and people have been hitching their wagon to that. So you voted for the guy in office. You're loving what's going on. Corporate earnings are strong, right? You didn't vote for the guy. Well, inflation's really high. It's costing me a lot to go to the grocery store and to the gas pump. This guy stinks. And I think I think whatever you could put look, I'm not a political analyst. You could put whatever reason you want to on it, but I think that's the reality we're living in, which again, usually I can keep those separate, but it's bleeding over into consumer sentiment, which is a metric that my industry has used for a while to see how people are feeling. And it's become notoriously unreliable. And I don't think it's exclusively political. I also think it's socioeconomical. I think part of it is you're seeing spending on average go up because the households, right, the more white collar households, the households who are earning more are spending more. Their wages have also grown 5 to 10% over the last 5 years or so, and they're spending it, right? That's money right into their pocket, and kind of the bottom, more borderline impoverished, right? Because that's the nature of our capitalistic economy, is a lot of those people are really feeling the inflation squeeze. So no matter where you voted, really, you might just be feeling more pressure based on what your income levels are, right? And there's the dichotomy of politics, and there's the dichotomy in the widening wage gap that is, I think, greatly affecting the sentiment numbers, right? So it's hard to see how, the average person, right? If you're not to get too dorky, but if you look at like the mean, right? Everybody's feelings, or the entire data set divided by the entire group, right? Will give us the average, but the median is like who's the one who's smack dab in the middle. I think that's probably more telling than saying how the group feels, right? How does the group feel? And let me summarize that in a number. That's what consumer sentiment does, rather than saying, all right, who is probably our most average person and how do they feel? Impossible. It's a really intangibly driven thing to do, right? It's a hard thing to measure to begin with. And now you're throwing a lot of different components at it that are making it really tough to measure. So I've been having a hard time hitching my economic analysis to sentiment, and that keeps growing. Because it used to be a really reliable metric, and it used to be really telling, and it used to inform the economy and inform investments. And I just don't think, I think there's a lot of economists and a lot of portfolio managers who probably would agree with me. I'm sure there's plenty who don't. But that's kind of my stance on it, and why I'm saying we got to start taking this number with a grain of salt going forward. So I don't know your thoughts on that.
Well, I break down the wage inflation number into 3 categories, because there's the lower income part of society, there's the median, like you pointed out, and then there's the wealthier part of society. I kind of take the wealthy out because I view that wealthy meaning, let me define it in these terms, not the ultra wealthy. I define that as people that tend to be economically resistant. So if prices are going up, they're complaining, but they have plenty of money to keep powering through. They've had plenty of normal raises. After COVID in 21, the lower income group had the fastest wage increase for years. In some cases, they got close to double-digit wage increases, which I was fine with because those people were always underpaid anyhow. Mm-hmm. And that's the part of society, and Haim, that's a part of society we need to take care of anyhow. People that need a hand up, not a handout, and that's most of the people that I run into. Mm-hmm. But as of late, that's shifted. It's shifted to the wealthier have the highest wage growth. So you get back to the median. The median has had wage growth a little bit above inflation, and the lower income is barely to inflation. So they're the ones that are struggling the most. That's why you see things like, and I'm, again, not a company endorsement, this is an example, companies like McDonald's reviving their value meals because that sector was such a driver of their sales that for a while they were increasing their prices too much. And the thing became a value meal became as expensive as a cheeseburger and fries and a Coke at Chili's. Mm-hmm. So Chili's flourished, McDonald's didn't, right? So there's companies out there their business models very sensitive to income classes. So they've been retooling their pricing for that so that they can make sure that they're moderating that. Those are going to be the companies once this fuel or energy inflation begins to subside. I think that's where competition is going to go back to market share. You take the grocery store game, right? There's so much competition in the grocery store game that not everybody can raise their prices and keep it there. You're going to have one of those competitors saying, look, sales are down, so we're going to start running some heavy duty specials to drive foot traffic. So I think back to, the price of oil is going to be what it is. It's going to drop to where it's going to go. It's going to take as long as it takes to get there. All things out of our control. Mm. Companies can't wait. If their sales are lousy or their sales are down, back to where we started the conversation with having stronger earnings, what are they going to do to drive their sales? What are they going to do to drive their earnings, right? So I think the beauty of living in a capitalistic society is prices in a lot of cases can't stay there because their consumer didn't have the increase in their income to continue to shop and buy from them.
Yeah. And see, I hear you, and I tend to agree with you, but I think there's a lagging effect that's been happening over a longer period of time, and I think the wage gap and really how the lower income models earn and spend it's very limiting. Of course, and that's more of a I guess that's kind of a borderline political opinion, but it's also just kind of an observation of really, when I start to think about inflation, I start to think about it's something I think about when I'm unpacking the consumer sentiment numbers, and I think it's important to keep in mind. I don't think that businesses have solved the problem of poverty, and I don't think they're ever going to. They're in the business of money, so
yeah, but there's a lot of businesses built for the lower end consumer, I guess is my point.
You're right.
And
right.
They're the ones kind of taking it on the chin and trying to get that business back, because what flourishes in an environment like this, store brands, because they're less money, right? And people start making those sorts of concessions. So, but again, back to the consumer sentiment where this whole conversation started, I don't see that changing. And again, I guess where I look at it, if I'm going to say I look at it, is I'll tie the consumer sentiment back to the savings rate to see because typically the less confident somebody is, as you know, the more apt they are to save because they become less confident in their future. So I think where consumer confidence makes sense in today's world is it's keeping people in check. It's keeping people away from being exuberant with their spending. Which, as you know, when we go from confidence to exuberance, that's when we go towards recessions. That's why I keep saying I don't see, and that's always the main trigger, whether corporations are exuberant with how their product's going to be purchased, or whether the consumer's exuberant, saying, "Oh, everything's awesome. I can keep spending. I know I'm going to get a raise next year. We can buy a bigger house than we thought, or we can buy a nicer car than we thought." Kind of keeping all that in check.
Yeah. Well, actually, I think that was a great point you made. Is you're focusing more on and you're using savings rate to color the. Sorry to just circle back and kind of put a bow on the consumer sentiment. Is you're focusing on consumer savings rate and things like that, which is at the end of the day what consumer sentiment exists so it could track consumer behavior, but consumer sentiment is no longer tracking consumer behavior. So we have to actually track consumer behavior. So yeah, that's a great kind of metric and jumping off point to measure that, right? So
yeah, but that's the only way I can look at it and say, okay, we know that their spending doesn't match their mood.
Yeah.
But if they're less confident, what else are they doing? So that's where it ties back to the savings rate. So the savings rate's still robust. And as long as that's robust, then that's where I think we still have that balance. So that's where consumer sentiment stays relevant to me, looking for that exuberant stage. And since it's not there, they're still buying all the stuff they said they're going to buy, but saying, I don't know.
Yeah, it seems like people are both, some people are exuberant and some people are whatever the opposite is. It just depends who you ask.
Well, it's what we've said many, many times on this show is some people see red, some people see blue. Our job is to see green.
Exactly.
And
exactly.
see how that all ties back together based on, people love it or hate it, to the point you brought up earlier of their political perspective. And, one can say things are lousy, the other, their next door neighbor saying it's awesome, just based on their point of view, right?
Yeah.
Right?
Yeah.
But whether you're red or whether you're blue, your consumer sentiment still reads the same.
Yeah, because you're all pulled into the same number. You're all pulled into the same number. Because consumer sentiment is just looking at you as person A, person B, not blue person, red person.
Right, right. So that's an interesting metric. So so I think that's been a lot going on in this quarter, is how the consumer feels about things and watching what their behavior. The war making people less confident, but not changing behavior, which is fascinating, because back in the day, Steve, and this is going back a long time, when you'd go back in the day and there was war, they were asking you to conserve. And there's people out there that know what I'm talking about because of the resources needed for the war.
You're talking about the Arab oil embargo?
That, right.
Yeah.
I think it was Jimmy Carter. Forgive me, listeners, if I get this wrong, but I was a little kid. I was like 12 or 13, and I remember the acronym was WIN, Whip Inflation Now. And they even had buttons. And they would say things like, turn your thermostat down to 69. Well, we lived in a drafty house. 69 felt like 40.
Yeah. Oh, my gosh.
But we did it. So same thing. But now there's there's none of those conversations about conservation. It's just everybody marching on, and the war seems at this point to have been just an enormous amount of political headline risk.
Yeah.
At this point.
It's just inflation. It's just a decrease in supply, which increases the price, not a stockpile issue, right? Not a literal, we don't have any, we don't, not like we faced back then. I'm sure, based on what I know, not what I lived through.
All right. I got to take a break. But when we get back, Stephen, I want to talk about our clients' behavior over the last quarter, the questions we've been getting, the meetings we've been having, and how we've been helping our clients navigate this past quarter. Deal?
Sounds great.
Okay, this is Leo Daprile. This is the Gem Young Wealthcast. We'll be back after this break.
And Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Hey there, this is Dan Rivers. Friends, if you're planning for a work-optional lifestyle or looking for financial insight or just want real conversations that help you make smarter decisions, we've got you covered. Listen to the Gem Young Wealthcast anywhere you get your podcasts, including Apple Podcasts, Spotify, and the iHeart app. And now you can watch the full video podcast on their YouTube channel. Gem Young Wealthcast with Leo. New episodes every week featuring professionals, local leaders, and conversations that matter.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back to the Gem Young Wealthcast. This is Leo Daprile. This is our second installment of our analyst series for the quarter, and I have with me Stephen Daprile. He's the president of Gem Young Wealth Advisors. He's also a certified financial planner, or CFP for short. Hey, Stevie.
Hey, good to be back.
Yeah, so we started the conversation today with consumer sentiment. So with all of the four analysts that we have, I want to give you different points of view so that you have broader thinking and you get a better thought process of everything that goes into what we do. And as you know, if you're one of our clients, nothing of what we do is off the shelf. It's very thoughtful. It's very customized to each of our clients. So it lends to different conversations than just how did the market perform? Because one of the questions, and we're going to talk about it in this segment, Stephen, is client behavior in the last quarter, our client behavior in the last quarter, the meetings we were having, the questions we've been getting. And I think that would be relevant for listeners to hear today is where are people landing on it? Because it's a common theme that we have throughout our meetings is there's a lot of headline risk lately, a lot of political risk lately, a lot of market volatility lately, a lot of news, SpaceX going public on the good side. Long time since we've had this large of an IPO making Elon Musk the first trillionaire, which is incomprehensible money to me. Oh my gosh. But that's a conversation for another day too.
I think we could do a whole podcast on that one.
Yeah. But let's talk about, because our clients are coming in with their fears, because they're, we watch, you know me, I read 3 to 4 newspapers a day. And I read from different points of view. I want to read what our clients are reading. I want to watch what our clients are watching. I want to see other points of view to see what other people are saying. And there's been a lot of drama in the quarter, right? So, and that impacts people, because they see and hear and that's what they know. Mm-hmm. But when they get here, we're having different conversations, different levels of conversations.
Yeah.
So let me kick it off with that by saying, what have been some of your more interesting ones in terms of questions and responses?
Yeah, that's kind of the thing that might surprise the listener most is it's been relatively quiet. And my guess is let's start putting this into perspective. Why would that be? Why are people not at a point of? I think there's concern. We've had it's not that I haven't had questions. It's not that I haven't had concerns. It's just that I haven't had anything that I would consider to be an outsized level of concern, or any clients doing things that I've had to kind of quote unquote talk them off the ledge for, or stop them from doing, or try and talk them out of doing something that would be irrational, right? There hasn't been a lot of that. I think what we're looking at here is a lot of our clients have investable assets with us, and over the last 5 years, other than 2022, everything has been off to the races. And guess what? You look at the market, everything's kind of still off to the races. So no matter what sort of volatility we've seemed to face, or what anxiety we've seemed to face, it seems like every quarter people get a little less concerned, is what I'm noticing. So this war, I think at first, and this was really last quarter more than it was this quarter, when the war was initially launched and people had fears about oil and people had fears about how this was going to affect the economy. Well, we've had a full quarter to see it play out, and it's, a little bit of inflation, right? We'll see how that works out the rest of the year, but the end of the day, the market's still been up because earnings are strong, right? So I think, again, I'm trying to put it into perspective in my head for why there's been less concern. I think the reality of it is first of all, people know that their money's being professionally managed, and we are taking care of, we're taking opportunities when they present themselves and taking a defensive posture when they present itself. But people have made their money too, so they are okay and understand to a certain degree that there is going to be volatility in the market. Something we talk about with our clients up front is like, hey, it's not always sunshine and rainbows. There's going to be volatility. There's going to be bad times in the market. And honestly, if you're looking at this past quarter, first of all, the past quarter was great. And the quarter before that I wouldn't even classify as a bad time in the market. You know what I mean? I would consider that anxious, right? Fear, a little bit of fear, but not bad, right? Nothing economically bad, right? Things that could be things that we are concerned about. And I think communicating that to our few clients who have been more on the, okay, what does this mean? I did have one client say, should I, and this wasn't this past quarter, but it was the quarter before, I had one client ask me, should I put all my money in cash? I don't, of course you invest for your goals, not invest for the market. So I'm not going to say whether or not that was a good idea or bad idea. I think the listener could probably figure out what I advised and how that played out. So
very happy with your recommendation.
I'd like to think so. I'd like to think so.
Talked them off that ledge.
So what's been your perspective? Because we service similar clients. We service some of the same clients, but our demographics are probably a little bit different on that as well. So I'm curious what are you kind of more muted than you would have expected, or what's your stance on that?
I think it's years, Stephen, where I've always felt that's, and then we see this all the time with other financial advisors where they're constantly benchmarking their clients against the indexes and all of that stuff. Mm-hmm. And none of our portfolios match an index because they're too customized to say you compare with X or you compare with Y. It's been from the beginning of our financial planning practice where when we build a financial plan, we build a goal rate of return for the plan. So the relevant benchmark is how are you doing in relationship to your goal of what you need to achieve? Naturally, we benchmark our managers against their peer groups. Mm-hmm. It's not like we don't do that, but it doesn't happen on the client level because of the level of customization that we have. So the relevant benchmark is what do we need that plan to do for them to have the work optional lifestyle in the life they choose to have. Mm. And we're killing it. Mm-hmm. So that's the focus of my meetings is not, hey, you did just X. Here was your portfolio performance, but here was the plan, the goal we have in your plan for you to meet or exceed for you to continue on. So even as we had meetings in early April after the disruption of the war and we had the immediate correction that we had because of which, by the way, 5 and 10% corrections within the course of a normal year are normal.
Extremely common.
Right.
Not even normal. Common. It's just, what I mean? Sorry to cut you off, but a 5% correction happens, I think, on average 3 times a year.
Yeah.
Sorry to cut you off.
No, that's okay. And that's a good point. Because I think Stephen too, because a lot of our clients have been such long-term clients and they've become friends. We get to know them very well. They listen when we talk, and they trust us when we guide. So when we've had these conversations over the year by saying, and they've heard me say this, I always live with and manage money with a healthy dose of paranoia. Always have. I've always done it with the perspective that another recession could be right around the corner. I prettied up by saying that's why we perform risk management, okay? Mitigate the risk, manage the risk in case when we go through that next market correction. It sounds pretty, but those are real thoughts. Those are real strategies of what we do because it's going to happen again. Mm-hmm. And we don't want to leave our clients overly exposed. So when we go through these corrections, they go, well, that's not nearly as bad as the markets, because that's what they know. And then again, we bring it back to saying, okay, how did that affect your plan? How did it affect your ability to live the life you choose and if you're in that work optional lifestyle, to maintain it, or you're still aspirational towards that, to make sure that happens. So, and the joke is, my clients have been with me a very long time. With events that go on, they don't even call me anymore. They know we've had the conversation so many times. They know what I'm doing. They know what we're doing as a firm. They just don't get rattled anymore. So that's part of what we do, and why the way we do it matters so much, because it's about peace of mind, right?
Yeah.
I always say that we're not the most sexy conversation at a cocktail party when the market's rocking and rolling, but we are when there's a market correction.
Yeah. Everybody's like, oh, what do you think here? What do you think there? Right? What's this mean? And it's just, yeah. I mean, I think we look better when the market's up. Just handsomer. Hair looks longer.
Everybody does.
Yeah. I certainly agree. I think we have a duty that we have to be benchmarking the performance of whatever investment options we are deploying for our clients, right? And that's important to us, to make sure that we're providing our clients with the best option available to them. But that doesn't help you, whether or not your portfolio is 1% or 2% off from its benchmark. It doesn't really matter to you. What matters to you is, am I getting that percent rate of return on average that we said in the plan that will help me achieve what I want to, whether that be just you maintain your standard of living, whether that be on track for your purchase goals or savings goals, whatever that may be. At the end of the day, that's what we have to do to make sure that we are giving you the edge that we certainly try and do. We have to make sure we're giving you the edge. And at the end of the day, we're making sure that your anxieties shouldn't be they should be about your life. And that's why you hire us. So you don't have to worry and think through and keep yourself up at night with this level of stress, right? You offload it to professionals.
Right.
So
I always say that, and this is a good time to talk about this with our clients, especially and I want listeners to understand this, when you live your life and the way things get managed on your behalf gets crazy granular, okay? Because at the end of the day, what really matters isn't stock market performance or investment performance or gains and losses. Is there enough money in my pocket if I want to take my kids for ice cream and me not worry about it? That's how deep I think about this with our clients. That's what they're really asking from us at the end of the day, is for them to have that peace of mind to do those things. But at the same time, we compete with all this noise.
Yeah. Because
they're hearing it's the world we live in. You've heard me use the term gotcha media, and everybody's trying to get your attention, just which we've talked about before. There's so much media choices out there that they're just trying to get your attention, and the more shocking something sounds, the more likely it is to get you to stop, because if it's same, you've moved on to something else.
Exactly. Yeah. You never seen a news article just saying like, hey, everything's pretty normal, not too bad, not too good. Right. You don't, nothing to see here today, right?
Yeah.
We actually don't have much to talk about today, so you can keep scrolling. You know what I mean? Or you could go to the next article. It's like,
you can go ahead.
Breaking news.
You can say it again. You can say it for the Star Wars fans. Go ahead.
Which one's that?
These aren't the droids you're looking for.
These are not the droids you're looking for.
If you're a Star Wars fan, you know what he means.
If you're not, I'm very sorry.
Yeah. There's a bunch. All right, so where do you see the world going for the rest of the year?
Very curious. I'm very curious. I think I'm still thinking more of. Sorry to be the bear, but I'm still thinking more of and I don't think this is inherently bearish. Obviously, it's not. But I'm still thinking more of a single-digit type of S&P type performance in the stock market. I think bonds. Big question mark. Bonds all depend on what the Federal Reserve is going to do. But I think earnings have been strong. I anticipate that persisting. I anticipate, we're priced pretty much to perfection still. And not that I necessarily see a pullback, but more that I see just no rational. I'd love to see no rational exuberance enter the market. I'd like to see us have a normal year like we've had, where things aren't normal, right? And have the occasional volatility and wind up with rational, sensible single digit rates of returns in the stock market. And I anticipate bonds being flat with candor, and I expect the earnings from those to come from the yields of those, and not necessarily from the increase or decrease in the value of them. Because I think so much uncertainty with inflation is really going to affect the pricing of those. So that's kind of where I'm seeing things. That's what I'm anticipating, subject to change. This is not a buy or sell recommendation.
Yeah, and I think what's going to play out too as we get deeper into the quarter is where the analyst estimates come in. Mm-hmm. To your point, are we priced to perfection? One of the questions I get asked a lot, and I've had it a couple of times in the past couple of weeks, is, we're at a market high, and I'm like, yeah, we are. We've been at lots of market highs, but people see that number and they still get caught up on that number, thinking, oh my gosh, a correction has to come because things have gone up too much. That's why we have to flip back to being more data dependent on that. And that's where we say, okay, let's look at earnings first. Did everybody earn the right for things to be where they are? Whereas if there's exuberance, where is it? Like we talk about all the time, if there's exuberance, it tends to be sector specific, not the general economy overall. So that's been that. If I would say I've had one dominant question over the last quarter, it would be like, geez, we're at a market high. Are we due for correction? And there's a certain logic to that, but the question is really coming from an emotional point of view because they're like, gosh, things are so well. My accounts are up a lot. I think I'm doing well. I'm blowing past my rate of return that I need for my plan to work. Where's the other boogeyman at?
Yeah.
Right? And that's the human condition.
Exactly. I think so. Yeah. A lot of people out there with their life figured out and everything's perfect, twiddling their thumbs saying, all right, when's the ball going to fall? Yeah. It's just, I think that's the nature of being human, like you said.
Well, I think that ties back to consumer sentiment. So that's where I think it kind of shows up because their lack of confidence, either because, like you brought up earlier in the podcast, either their lack of confidence in their political leaders or the political movement or the current, and I hate the word transitory inflation, but I really think this might be transitory inflation this time around. I didn't really buy into that completely last time. I thought when Jerome Powell said we had transitory inflation at first, I'm like, okay, well, that's where the Fed's coming from. Then after about 3 to 6 months of it, I went, no, it's not.
Yeah.
This isn't going away anytime soon. But I think this one's different.
I do as well, for what it's worth. I do as well.
Okay.
It's just what's underneath that. What's underneath the oil issue, I think, is still bubbling. That's my only concern.
Yeah. Okay. So I'm of the same opinion. I think the economy still sits in a nice position. I think there's a lot of still profitable companies, and I think the proof's been, and especially after Q2 of this year, how many companies, especially in the S&P 500, showed revenue growth and earnings growth, which was the first time. Well, it's been a long time since so many companies were there, which showed me, from a data point of view, how much health there was to the economy overall. And I don't see that flipping in a quarter. And I think after getting out of this Iran war, I don't think there's going to be any hurry to go do something like that again, too.
Yeah, I think so. I definitely think so. It seems like the leadership has made a concerted effort to go after countries with oil reserves, and I mean, mission accomplished from that perspective.
Right. Which we'll see what that means in the future in terms of the flow of oil and where things really come, because I think the potential here for, if this oil glut really becomes an oil glut and oil becomes really cheap, great for the consumer, but there's going to be a lot of Middle Eastern countries that their economies are built on oil being a certain price per barrel.
I think they're looking at that regardless with AI data centers and the amount of energy that we need to do those, and nuclear energy percolating back up into the top of discussion, which is a very, very interesting use of resources. I think alternative energy over the next decade is I'm going to be keeping my eye on how all that plays out. That's for sure.
So I know we only got about a minute left, but let me just respond to that by saying this. If oil becomes super inexpensive, do those alternatives matter anymore? Do they then become more expensive than a gallon of gas?
Yeah.
Right?
Maybe.
And if you're building something and you're trying to drive down your raw material costs, and oil's the cheapest date in town, where are you going to go?
Yeah, my understanding is limited, but nuclear is actually pretty affordable. Is kind of the thing. It's actually kind of it's borderline steam powered is the way it actually works out. From my understanding,
it's phenomenal if they can only figure out what to do with the waste.
Well, yeah.
Other than the fact that it's toxic,
Right? No, but there's significantly less, and I think it's anyway. Have the physicists on. Let them talk about that. I'm just a financial planner.
Well, again, I'll answer that by saying let the red and the blue debate it, and the green will look at the opportunity to make money at it.
That's what I'm saying. Yeah, that's what I'm saying.
All right, Stevie, great having you on today.
Always great being here. Thanks for having me.
Yeah, believe it or not, we are out of time. So, okay. All right. Thanks again, Stevie. Stephen Daprile, president of Gem Young Wealth Advisors, and he's a certified financial planner. All right. This is Leo Daprile. This is the Gem Young Wealthcast. I'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we know every financial journey is unique. That's why our team of financial planners, paraplanners, and service professionals work together to provide personalized strategies for a work-optional lifestyle, investments, and risk management. We're here to help you plan for today, protect tomorrow, and enjoy the life you've worked so hard for. Take the first step toward financial confidence. Call Gem Young Insurance and Wealth Advisors at 330-533-6936 to schedule your fit meeting today.
Hey, it's Medicare Jer here from Gem Young Insurance and Wealth Advisors. Medicare can feel confusing, but I'm here to make it simple. With the right Medicare Advantage or Supplement plan, you can worry less about unexpected healthcare costs and focus more on enjoying life. Let's make sure you've got the coverage that fits your needs and gives you peace of mind. Call me, Medicare Jer, at Gem Young Insurance and Wealth Advisors today at 330-533-7941 to schedule your appointment, and let's get your plan in place.
By calling this number, you will be speaking to a licensed insurance agent to answer your questions or provide additional information about Medicare Advantage plans, prescription drug plans, or Medicare Supplement insurance plans. This is an advertisement for insurance.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning. At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back to the Gem Young Wealthcast. This is Leo Daprile. Well, we have installment 2 in the books. We had Stephen Daprile on today and wanted to give you different points of view than you're going to get from the other analysts, which is, again, broaden your perspective, give you different things to think about. Again, I always think it's interesting how consumer sentiment isn't matching market performance or consumer behavior. I find that an interesting topic in the fact that it doesn't seem to be changing. But it is giving me the indication of savings rates increasing, which means we have a more conservative consumer that continues to consume. Or earnings, as they come out more and more this month, will give us a better roadmap of where we're going for the rest of the year. But I think there's optimism still for the rest of the year. And I'm looking for, you know me, I'm always looking for the boogeyman under the bed. And right now, I'm simply not seeing him. And we had a shock this year with the Iran war so far, and we had the initial decline in the market because of that, because, markets don't like uncertainty. You hear us say that all the time. And this was certainly an uncertain time. But rationality always prevails. And that's what happened in this case, too, that once that settled out and we saw where the damage may or may not be, things were off to the races. we didn't have much of a time to talk about maybe where AI is playing out, but we'll get to that in later shows. Planning for that conversation down the road because it's a constant conversation. But again, here at Gem Young Wealth Advisors, what we're trying to do is match your performance to goal rate of return for your plan. Because again, we talk about that a lot, but that's what matters to you. We've been exceeding that by a great deal for our clients. Fortunately, markets behaved in a way that's allowed us to do that. But it also goes to getting to know who you are, making sure that what we build matches you. That's why when we go through these scenarios that we went through earlier in the year, our clients know. They know we're handling it. They know we're on it. We get very few panic calls, if any at all. When we have client meetings, clients are pleasantly surprised with performance because what they're hearing out there and what's actually happening to their portfolios are two different things. And we know that. So, because we're watching it every day. We're meeting with analysts on a regular basis. We're reviewing their financial plans frequently. So all of that takes work, but it's what makes us who we are. And that's what makes us different from what so many other people are doing. So, and we talk about this, that this whole quarterly result of having these analysts comes down to giving you perspective of how we build our business and how we manage things for our clients so that you can see it's not just a one-size-fits-all scenario, but a highly customized situation for each of our clients built for what they're trying to accomplish. But we got to know what's happening in the world, and things are dynamic. You are dynamic, and that's the way the world works. So we're always changing as we need to. We're not afraid to change, and we're not afraid to adapt. We're not afraid to go right or left if that's what it takes to help manage the objectives. So if you're new to the podcast, appreciate you listening. Check it out anywhere you get your podcasts, and check out our YouTube channel so that you can see the full video version of it. I appreciate you listening today. This is Leo Daprile. This is the Gem Young Wealthcast. Until next time.
Wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
Hey there, this is Dan Rivers. Friends, if you're planning for a work optional lifestyle or looking for financial insight or just want real conversations that help you make smarter decisions, we've got you covered. Listen to the Gem Young Wealthcast anywhere you get your podcasts, including Apple Podcasts, Spotify, and the iHeart app. And now you can watch the full video podcast on their YouTube channel, Gem Young Wealthcast with Leo. New episodes every week featuring professionals, local leaders, and conversations that matter.
Join me every week where we talk anything and everything about your money. Have a topic you want to hear more about? Email Katie, that's Kayti, at gemyoung.com. You can find us on Apple, Spotify, and the iHeartRadio apps. Until next time, this is Leo Daprile.